Today, we will go through the investments in other companies.
Your company buys 70% of another business. Do you report 70% of its assets? No. Once you control it, you consolidate 100%, then identify the 30% you do not own. This lesson builds the complete group statement: acquisition, goodwill, non-controlling interest, eliminations, group profit, and what happens when control changes. Control changes the unit of account. We stop presenting one investment line and start presenting one economic group. The consolidation engine has 4 moves: add 100% of the subsidiary's assets and liabilities, eliminate the parent's investment against subsidiary equity, recognize acquisition goodwill, and show outside owners as non-controlling interest. The parent and subsidiary remain separate legal companies, but financial reporting treats them as one. Here is Delta Foods. It has assets of 10 million, liabilities of 2 million, and net assets of 8 million. Its annual profit is 1,200,000 and its dividend is 500,000. Alpha buys 70% and gains command over relevant decisions. Delta is now a subsidiary. Consolidation adds all of Delta's assets and debts, not merely 70%, because Alpha controls the whole operating platform. Alpha pays 6 million to Delta's existing shareholders. On Alpha's separate books, cash falls by 6 million and an investment in Delta appears. Delta records nothing, because its own assets did not receive the purchase price, shares changed hands between owners. Alpha acquired 70% of net assets worth 5,600,000. The excess 400,000 is goodwill. The remaining 30% is NCI. Use the acquisition method in 4 steps. First, measure the consideration transferred, 6 million. Second, measure Delta's identifiable net assets at fair value, 8 million. Third, recognize non-controlling interest, here, 30% of 8 million, or 2,400,000. Fourth, calculate goodwill. Under this proportionate NCI example, 6 million minus the acquired share of net assets, 5,600,000, equals 400,000. Goodwill is not Delta's existing asset and it is not a plug to hide poor analysis. It represents the acquisition premium, expected synergies, customer relationships, workforce capability, or other benefits that cannot be recognized separately. Here Alpha pays 6 million for a 70% interest worth 5,600,000 at fair value, so goodwill is 400,000. After acquisition, test goodwill for impairment, do not amortize it merely to smooth earnings. Non-controlling interest is the ownership that remains outside the parent. Alpha owns 70%, but the group statement includes 100% of Delta. To keep ownership honest, the outsider's 30% appears within equity, not as debt. At acquisition it is 2,400,000 in this example. Later, NCI receives 30% of Delta's post-acquisition profit and is reduced by dividends paid to those outside shareholders. Now build the worksheet. Start by adding parent and subsidiary line by line. Then remove everything the group cannot owe to itself, sell to itself, or earn from itself. The major eliminations are investment against subsidiary equity, intercompany receivables against payables, unrealized profit in inventory, internal gains on fixed assets plus excess depreciation, and intercompany dividends. Consolidation is therefore not simple addition. It is addition followed by economic cancellation. First elimination, cancel Alpha's 6 million investment against Delta's pre-acquisition equity. The investment and Delta's equity describe the same acquired net assets from opposite sides, so neither can remain in the group statement. Replace them with the underlying assets and liabilities, 400,000 of goodwill, and 2,400,000 of NCI. Only the parent's own share capital and reserve survive as group shareholders' equity. Second elimination, intercompany balances. Suppose Delta sells goods to Alpha on credit. Delta records a 300,000 receivable and Alpha records a matching payable. From the group's perspective, nobody outside owes or is owed that money. Leaving both balances would overstate assets and liabilities. Debit the payable and credit the receivable for $300,000. There is no profit effect, the group simply removes an internal promise. Third elimination, unrealized inventory profit. Delta sells inventory to Alpha for $360,000 that cost Delta $300,000. Delta records $60,000 profit, but Alpha still holds the goods. No external customer has paid the group, so the profit is unrealized. Remove $60,000 from profit and reduce inventory to the original $300,000 group cost. Recognize the profit only when the inventory is sold outside the group. Fourth elimination, an internal fixed asset sale. If Alpha transfers a machine to Delta and records a $100,000 gain, the group has sold nothing. Remove that gain and restore the asset to the carrying amount it had before the internal transfer. Then correct depreciation. Delta is depreciating an inflated internal price, so reverse the excess depreciation every reporting period for the asset's remaining life. This is a multi-year consolidation adjustment. At year-end, Delta earns $1,200,000 and pays a $500,000 dividend. Alpha's 70% dividend, $350,000, is cash moving inside the group, so it is eliminated. It is not group income. Delta's full profit enters consolidated profit. Then allocate $360,000, or 30%, to NCI and $840,000 to the parent. The outsider's dividend of $150,000 genuinely leaves the group. Now see the consolidated balance sheet. Add parent and subsidiary assets and liabilities at 100%. Cash becomes $9 million, receivables $5 million, inventory $5 million, property $12 million. The $6 million investment disappears and $400,000 of goodwill appears. Only parent capital and parent reserves remain, while NCI of $2,400,000 represents outside ownership. Total assets and total funding both equal $31,400,000. The consolidated income statement also uses 100% of both companies. Revenue is $20 million, cost of sales $12 million, gross profit $8 million, and group profit $3,700,000 before any further illustrated adjustments. Then attribute $360,000 to NCI and $3,340,000 to the parent's shareholders. The question is not whether Delta's profit is included. It is included fully, ownership determines only the attribution. Ownership levels can change. Crossing into significant influence normally moves an investment to the equity method from the date influence begins, with the required remeasurement of any old holding under the applicable framework. Crossing into control triggers acquisition accounting, goodwill, NCI, and consolidation. Losing control triggers deconsolidation and remeasurement of any retained interest. Falling below significant influence returns the investment to the relevant fair value or cost-based model. Never apply a new method retroactively without authority. Control is a fact, not a percentage. Majority voting rights are common evidence, but contracts or entity design can create control without majority ownership. Under a variable interest model, the party with power over the relevant activities and exposure to significant benefits or losses may have to consolidate. Conversely, a large shareholding without substantive decision power may not establish control. Reassess whenever governance, contracts, or facts change, and at every reporting date required by the framework. Put the full investment map together. Debt accounting follows the instrument and management's intent. A passive equity stake follows fair value or an allowed cost-based approach. Significant influence uses the equity method. Control uses consolidation, with goodwill and NCI. A variable interest structure can also require consolidation because control arises by design. One decision governs every method: identify the economic power and exposure before choosing the accounting label. Final CEO test. Ask 5 questions. What exactly did we acquire? Which decisions can we direct? What did we pay compared with identifiable net assets? Who owns the portion we do not? And what internal balances, sales, profits, assets, or dividends must disappear? If your group accounts answer all 5, consolidation is doing its job, showing one economic business without double counting, invented internal profit, or hidden outside ownership. Remember the consolidation rule: control brings in 100%, eliminations remove the internal noise, and NCI protects the ownership truth. That completes the CEO investment series.